The S&P 500 is currently at an all-time high, which means that many people are currently investing and or thinking about investing. In the investing world, we hear the terms index fund, mutual fund, and exchange-traded fund very frequently. All three of these are funds. In this video, I want to cover the key differences, specific examples of each, pros and cons, as well as my thought process on which one you should pick if you are a newer investor. First of all, what even is a fund? A fund is a pool of money that's intended to be invested under one investment objective. Why is it called a fund? Well, let's compare a fund to buying stocks. If you were to place an order to buy shares of Netflix, you are buying those shares in a secondary market from another investor. You're not placing an order directly with Netflix. With funds, you are buying shares directly from the fund. You are pooling your money with other people's money. The fund manager then takes that money and decides what investments to make. You, as a shareholder of the fund, are then participating in the income, the gains and losses of the fund. Now, whether it's a mutual fund, an exchange fund, an index fund, a private equity fund, a hedge fund, they're all funds and they're all fundamentally the same. There are some technical differences between all of these, including how accessible they are to you, who manages them, how much they charge, whether they trade on an exchange, what they invest in. But regardless, all funds are a pool of money with a single investment objective. Now, when you go into your bank, you will often see financial advisors that are able to help you with investments. And one of the most popular types of investments that you may hear them mention or talk about are mutual funds. You can go into a bank at any time and ask them to help you invest your money into mutual funds. Now, the person who's able to help you do this, that's not the fund manager, which means that that's not the person making investment decisions for the fund, but they can help you decide which funds would be suitable for you. You can also invest in mutual funds yourself through a self-direct investment app. Vanguard, for example, is one of the world's largest investment management companies. If you go onto their website, you'll be able to see all of their investment products. Let's click into mutual funds. So everything you see here on this list is a mutual fund, and every single one of these funds is managed by a fund manager. So for example, if you were to buy shares of Vanguard Equity Income Fund, you can see here in the product summary that this fund is designed to provide investors with an above average level of income. This fund typically invests in companies that are dedicated to consistently paying dividends. That's why it's called an equity income fund. Equity equals stocks, income from stocks, aka dividends, therefore equity income fund. So Vanguard Equity Income Fund takes this pool of money and they buy various equities such as JP Morgan, Broadcom, Johnson & Johnson. This fund owns 10 million shares of JP Morgan, and they own a ton of other stocks as well. These stocks on this list will pay the fund a dividend on a regular basis. And then that fund will distribute that dividend income to its shareholders, aka you. So if JP Morgan paid Vanguard Equity Income Fund $500,000 in dividend income for the year, that's a made-up number, but let's say that that's true. Vanguard Equity Income Fund will then distribute that $500,000 less any fund expenses, which include management fees, to its shareholders on a per unit ownership basis. So the minimum investment into this mutual fund is $3,000. The expense ratio is 0.27. But let's say you put $3,000 into this fund and that equals a 0.000001% ownership of the fund. You would be entitled to that $500,000 dividend multiplied by 0.00001%, which represents your ownership portion. And that income to you is what we call a distribution. If Vanguard Equity Income Fund sold all of this JP Morgan stock and they realized a capital gain on that sale, that capital gain is also distributed to its shareholders. And so whether it's capital gains or income, this is how you would make money from a mutual fund. At the end of the year, if you invested this money in a taxable account, Vanguard Equity Income Fund gives you a tax slip, and it's going to break down that distribution, whether it's dividend income, interest income, cap gains. One more technical thing to note about mutual funds is that they don't trade on exchanges. They trade once a day at the end of the day at the net asset value, or what we call the NAV. This is a really important term to understand for anyone who is investing in any sort of fund. NAV. The net asset value of a fund is all of the fund's total assets minus all of its total liabilities divided by the number of units outstanding to shareholders. This is fundamentally different than stocks because stocks that are available to retail investors are traded on a secondary market, and stock prices on secondary markets are determined by supply and demand, which is driven by investors' future expectations. Now, in this example, the NAV of this fund is $47.18. That's very similar to what we'd call the stock price or the share price. And the expense ratio of this fund is 0.27%, which is considered relatively low for a mutual fund, but it's still higher than exchange-traded funds. Let's go to pros and cons. So the pros of mutual funds is that it's fairly accessible. You can walk into a bank and ask a financial advisor to buy these. Now, if you're not comfortable picking out your own investments, then that's what makes mutual funds really good because you can usually ask a financial advisor to give you guidance. And this approach dramatically reduces your risk associated with investing in individual stocks or ETFs. So in a down market, your risk would be protected. Another potential pro is that in the mutual fund world, there also exists this idea of a balanced fund that can allocate its investments across various sectors. Let's say that fund wanted to do 40% in tech, 30% in healthcare, 20% in financial services, and 10% in energy companies. If one of those sectors were to experience a downturn, the other sectors could help stabilize the overall fund's performance. This is different than being an individual investor trying to manually create a balanced portfolio. Mutual funds are intended to beat the market. So for example, if you purchased this fund, VPBIX, you would have access to this Indonesian bank. You would have access to a Cayman Islands company. You'd have access to this Taiwanese semiconductor manufacturing company. But VPBIX also invests in Shopify stock as well. I personally own Shopify stock, but I don't own any investments in the Cayman Islands or in the Bank of Indonesia. And this is because this fund tries to target emerging markets. So they're investing in the Taiwanese semiconductor market. Maybe the fund manager has done research on the Taiwanese economy and believes that investing in the Taiwanese semiconductor market can lead to higher returns than directly investing in American tech stocks like Apple, because a lot of Apple's microchips come from Taiwan, right? The whole idea behind mutual funds is to beat the S&P 500, but this is just an example of how a mutual fund is trying to do it. Now, because mutual funds are intended to beat the index with active management, they also cost more in management fees than your typical index fund and your typical ETF. And mutual funds can range anywhere from 0.5 up to 2%. Vanguard mutual funds are not too bad. This one here is 0.59%. Again, possibly because there is someone actively researching and keeping a pulse on the Taiwanese semiconductor market. So for 0.5%, let's say you invested $10,000, that's $50 of investment fees. Depending on the financial institution that you're with or the self-investing app that you're with, one of the downsides to mutual funds is that you may not get access to every single mutual fund in the world because mutual funds don't trade on exchanges. Sometimes, depending on where you live, every bank will have their own in-house group of mutual funds. For example, if you bank with RBC in Canada, they have their own native group of mutual funds. The downside of diversification is that even though it's lower risk, it's also lower reward. When you invest your money into a mutual fund, you're not going to be able to get a 200% gain like you would if you had bought NVIDIA stock a while back. Some mutual funds do have a minimum investment requirement as well. That's something to consider, as we saw here today on the screen. Next is exchange-traded funds. So just like mutual funds and index funds with ETFs, you also get access to a diversified group of assets based on the fund's investment objective. But ETFs are traded on exchanges and they have unique ticker symbols that let you track their price activity. So for example, a technology sector ETF like XLK allows you to invest in a basket of technology companies, including Microsoft, Apple, and NVIDIA, with the flexibility to trade instantly. So as you can see here, the NAV for this fund is $233.61. That's the net asset value. And the share price of this fund is $233.60. They are very close, which I'm going to explain in a second. and the expense ratio is 0.09%. So let's say you're investing in XLK. Let's take a look at what XLK actually owns. This is the financial statement of the fund, but you can see here that they mostly own Microsoft. That's their primary and biggest holding. They also own Broadcom here, $2 billion, and NVIDIA, another $2 billion. But you can also see here that they own a lot of other investments as well. And if you were to break it down by sector, most of their holdings are actually in software, and then the second highest is in semiconductors. Because ETFs are able to keep their administrative and operative costs a little bit lower since they trade on exchanges, the management fees tend to be a little lower than that of the mutual fund. So in this example, XLK has a 0.09% expense ratio compared to the mutual fund we looked at earlier, which is 0.59%. Now in this example, XLK is a sector ETF. Sector ETFs give you access to a very small portion of the market or that specific sector. So in this example with XLK, the sector that you're exposed to would be semiconductors, software, and tech. Sector ETFs are a little bit more narrowly focused, so while they have room to grow, you can also be exposed to the downside if that entire sector goes down. Speaking of sectors, there are also healthcare ETFs, real estate ETFs or REIT ETFs, energy ETFs. Basically, in those ETFs, they would just be investing in a basket of securities in that sector. The other type of ETFs are index fund ETFs. So an index fund can either be a mutual fund or an exchange fund. Remember, mutual funds do not trade on exchanges. They're generally more passively managed. ETFs trade on exchanges. So one example of a mutual index fund is VFIAX, Vanguard 500 Index Fund Admiral Shares. It's also available as an ETF, but this one is a mutual fund. Now, the expense ratio for this is much lower than an actively managed mutual fund. It's at 0.04%. But in this example, instead of having a fund manager track the Taiwanese semiconductor market and the Indonesian banking industry, this fund's objective is just to track this particular index, which you can see here is the 500 of the largest US companies. What are the 500 largest companies? Well, you can see down here, this is the list of the first 10 of them. But as an index fund, the criteria of what allows a company to be considered a part of the index is already predetermined. If you invest in an S&P 500 index fund, you are investing in the 500 largest publicly traded companies in the US. It operates like a mirror that reflects the movement of the market. Because the investment objective of the fund is predetermined, the costs associated with managing the fund are also lower, right? There's no active management involved or necessary. So it really is just simplicity and low cost. Unlike mutual funds, they don't try to beat the market. They're just trying to match the index performance without trying to take extra risk. And the good news is that over the many years, this approach to index fund investing has been remarkably successful. Now, the ETF version of this index fund is called VOO. This one is a really popular one. But as you can see down here, in terms of the holdings between the two, it's basically the same thing, right? You can see 9.1% communication services, 9.1% communication services. In fact, they are basically identical because they're investing in the same thing. It's just that one is an ETF and one is a mutual fund. You can also see here that they're distributing basically the exact same dividend income across both funds. Barely a difference at all in terms of dollars per share. So one of the biggest pros about index fund investing is that the costs of management are significantly less, allowing index funds to charge lower fees compared to mutual funds. So a very typical S&P 500 index fund, which we just looked at just now, charges as little as 0.03%, which is on a $10,000 investment, $3. Now, over decades of investing, these really small differences in investment fees can translate into hundreds, if not thousands of dollars. But one great fact about investment funds is how accessible it is for the average investor. Right. Before this, prior to index funds existing, sophisticated investment strategies were only available to wealthy individuals or institutional investors. And so typically with these, you will not have any sort of minimum investment required. You can start with $50, you can start with $100. Online trading platforms have made index fund investing more accessible than ever. The only cons with index fund investing is that you personally do not get to choose the composition, and because of that, you cannot beat the market. You can achieve market returns, but you can't outbeat the market because the fund is intended to track a part of the market. Now, you might be wondering, which one is the best investment option of the three? There are generally no blanket investment statements, but for a newer investor that has lower to moderate risk tolerance, index fund ETFs is what I would recommend. You can get them in a tax advantaged account and make sure you maximize your tax advantage accounts before moving on to a taxable account. Again, index funds, fees are lower. A lot of trading apps will offer you low cost ETF trading. You can self-direct invest. You get the built-in diversification. And over the last few years, when adjusted for inflation, the average annualized return for the S&P is 7.28% when adjusted for inflation. And you can see why this investing approach has been so popular. If you guys like this video today, you're definitely going to like my other video on how to invest in cryptocurrency and Bitcoin. If you've never bought Bitcoin before, I laid down a very step-by-step and beginner-friendly approach, as well as all the safety measures and protocols that you can take to make sure your crypto investments are safe. So make sure you check out that video up top here. Let me know down in the comments below what your preference is between an index fund, an ETF, or a mutual fund, what your experience is with these investments, and I'll see you guys in the next video. Until next time.